This is the short note for balance of payment. Introduction. Annual financial statement versus balance of payment. Before understanding the balance of payment, it is important to distinguish it from annual financial statement, which comes under Article 112 of the Constitution. The annual financial statement, which is also called Union Budget, is the government estimate of receipt and expenditure for a financial year. It has two major parts: revenue account and capital account. Inside revenue account, we have revenue receipt and revenue expenditure. Inside capital account, we have capital receipt and capital expenditure. Now, coming to revenue receipt, we have tax revenue and non tax revenue. Inside tax revenue, we have direct and indirect tax. In the revenue expenditure, we have salaries, subsidies, interest payment, pensions, etc. In the capital account, inside capital receipt, we have borrowings, recovery of loans, disinvestment. In the capital expenditure, we have creation of assets, infrastructure, loan to the states, etc. The key point is union budget records the government finances, whereas balance of payment records the country's external transaction. Balance of payment is a systemic record of all the economic transactions between a resident and non-resident of a country and rest of the world during a specified period, generally 1 year. It is maintained by RBI, prepared according to IMF Balance of Payment Manual, BPM 6. Transactions are generally expressed in dollar. Credit will be positive, foreign exchange that enters India. Debit will be negative, foreign exchange that leaves India. So the formula for balance of payment is current account plus capital slash financial account plus error and omission plus change in forex reserve. Coming to the current account of the BOP, current account records the transaction that do not create asset or liability. It consists of two types: visible trade and invisible trade. So visible trade means trade in goods. Major imports are crude oil, gold, electronics, chemical, heavy machineries. Major exports in visible trade are petroleum product, engineering goods, gems and jewelries, pharmaceuticals, agriculture product. So the balance of trade is export minus import. If it is positive, we say trade surplus. If it is negative, we call it trade deficit. India generally experiences a trade deficit because import, especially crude oil and gold, exceeds the merchandise export. The second part, invisible trade, which is a part of current account of the balance of payment. Invisible trade consists of service, income, and transaction. In service, we have IT service, software export, tourism, banking, shipping. India usually have a service surplus because of the strong IT export. Income, income earned from the investment, like interest, dividend, profit. India generally record a net income deficit because of the profit and dividend are paid to the foreign investor. The third one, transaction. Transaction without any return payment. Example, remittances, gift, donation, pension. India received one of the world's largest remittance, in turn making transfer a major positive component. Now there is a concept of current account deficit. When import and other current account payment exceeds the receipt, the country experiences a current account deficit, CAD. A persistently high current account deficit increases dependence on the foreign capital. The measure to reduce CAD is increase the export, promote manufacturing, make in India, improve agriculture productivity, strengthen service exports such as IT, reduce dependence on imported crude oil through renewable energy and domestic production, discourage excessive gold import through appropriate policy measure. The second component of BOP is capital account or the financial account. The capital slash financial account records transactions that create asset or liabilities. It mainly consists of investment, loans, and banking capital. In the investment, we have FDI and FPI. FDI, which stands for foreign direct investment, is a long term investment which creates productive assets. bring technology, capital, and employment. In the listed company, 10% or more investment is treated as FDI. In an unlisted company, foreign investment is treated as FDI. Applies primarily to the equity. Foreign portfolio investment. Earlier it was called foreign institutional investment. The characteristics of FPI is short-term investment, investment in shares and bonds, no management control, more volatile than FDI. The second one uh, of capital account is loans, which is sovereign loan, ECB, external commercial borrowing, multilateral assistance from institutions like IMF and World Bank. The third part is banking capital, which include foreign currency non-resident account uh, account deposit, FCNR deposit. So FCNR account allows NRIs to keep deposit in foreign currencies. Overall balance of payment. Suppose current account is minus 32 billion US dollar, capital account is plus 47 billion US dollar. Then capital inflows finances the current account deficit. If overall balance of payment is positive, RBI purchases the excess dollar, Forex reserve increases, rupee appreciation is moderated. If overall balance of payment is negative, RBI sells the dollar from the Forex reserve, supports the rupee against excessive depreciation. Thus, Forex reserve act as a buffer during external shock. Now, foreign exchange reserve consists of foreign currency asset, largest component, gold, special drawing right (SDR), reserve position in the IMF. Importance: maintains exchange rate stability, boosts investor confidence, helps during the balance of payment crisis, ensures important import security, enable RBI intervention in the foreign exchange market. The balance of payment reflects the external strength of an economy. A sustainable current account deficit financed by stable capital inflows such as FDI, supported by adequate foreign exchange reserve and diversified export base, ensures macroeconomic stability. The 1991 BOP crisis highlighted the importance of prudent external sector management, making BOP one of the most significant indicator of India's economic growth.